Nigel Farage just lit up the crypto debate in Britain. According to The Telegraph, he accused dinosaur bureaucrats at the Bank of England of choking off British innovation and holding back the country's digital asset industry, arguing the UK is falling behind rival hubs. What is he reacting to? The backdrop is a tough policy mix. According to the Financial Times, the Bank of England has floated limits on how much of a systemic stablecoin people and businesses can hold, pitching caps of roughly £10,000 to £20,000 for individuals and around $10 million for firms as a way to protect deposits and financial stability. Farage's line is that rules like these, plus a culture of caution at Threadneedle Street, are throttling the sector before it can scale. Farage has been building a pro-crypto platform for months. According to The Telegraph's earlier reporting, he has even pledged the UK should hold Bitcoin on the national balance sheet and stop banks from debanking lawful crypto users, framing it as a competitiveness issue as much as a freedom issue. Today's broadside fits that message. He wants the central bank and regulators to move from risk first to opportunity first without ditching basic safeguards. Policy is shifting, but unevenly. According to the Financial Times, the FCA has sped up crypto approvals this year after criticism that applications were stuck for too long, and approval rates have climbed with more resources and clearer pre-filing guidance. Reuters adds that the regulator is consulting on a new regime that could give crypto firms a more tailored rulebook while still demanding strong operational resilience, custody, surveillance sharing, and consumer protections. In other words, Westminster is nudging the plumbing forward, even as the central bank keeps a tight grip on payments-grade stablecoins. Here is why the fight matters to markets. If the Bank of England's caps and caution dominate, the UK risks seeing tokenized money and on-chain payments scale elsewhere first, with liquidity and jobs following. If the FCA has faster approvals and a clearer ETF and exchange listing framework win the day, London could attract issuers, market makers, and builders who want rule of law plus speed. That tension is exactly what Farage is exploiting politically. He is telling voters that a more open stance can coexist with stability if the rules focus on transparency, custody, market surveillance, and accountability rather than blanket limits. There are fair counterpoints. The bank's core mandate is stability, not hype. According to the FT's coverage of the stablecoin debate, officials worrying that poorly designed coins used widely for payments could drain bank deposits in a shock, complicate lender funding, and amplify stress. In that world, transitional caps, rigorous audits, and phased rollouts look like a safety valve rather than anti-innovation dogma. The real question is whether those transitional measures stay temporary and whether the UK can build a pathway from pilots to production that global firms actually use. What to watch next? Reuters notes the FCA consultation window runs into November, so expect a flood of industry feedback on where to set the bar for integrity rules, custody, and market surveillance. Also watch how the Treasury positions itself between a speed up at the FCA and caution at the bank. If ministers lean into digital finance growth, you could see a compromise that tightens operational risk standards while easing firm-level approvals and clarifying payments use cases for well-regulated stablecoins. Bottom line. According to The Telegraph, Farage is swinging hard at the Bank of England to frame crypto as a growth and competitiveness story rather than a niche asset class. The next few months of FCA and BO rule-making will show whether London aims to be a top-tier crypto and tokenization hub or keeps its foot on the brake while others race ahead. You have been watching CRYPTOZARD News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you would like to hear in the future. The entire cryptocurrency market just hit a rough patch, and the pain showed up fast in liquidation levels. According to CryptoPodo, an Ethereum and XRP-led sell-off triggered about $600 million in liquidations over the last 24 hours as altcoins turned red and momentum flipped risk off. Let's set the scene for cryptocurrency traders. Ethereum failed to hold recent highs and slipped under key spots on the chart, while XRP followed with heavy selling of its own. CryptoPodo reports that Ethereum accounted for the biggest share of the wipeout, which tells you where leverage was stacked. When the largest altcoin rolls over, liquidation levels on perps tend to cascade across the board. Here is why liquidation levels matter on a day like this. They are the price points where forced closes pile up when moves accelerate. In cryptocurrency markets, those clusters often sit near obvious numbers traders watch. When price tags one cluster, the next one below can trigger in a chain reaction. That is why you can see fast lines followed by sharp bounces as the market clears the weakest hands and then resets. How to read today's tape without getting chopped. First, identify the nearest liquidation levels above and below price on your exchange's heat map or a public dashboard. If you see a thick band just under price, expect volatility if sellers press into it. If the next band sits just above, a relief rally can run quickly as shorts get forced to cover. Second, watch spot volume. In cryptocurrency downswings, a true flush prints elevated spot volume on the dump and calmer volume on the bounce. Thin bounces after a liquidation sweep are easier to fade. Let's talk ETH and XRP specifically. According to CryptoPodo, Ethereum led total liquidations as it dropped to a weekly low after repeated rejections near recent highs. That tells us leverage had crowded into longs during the quiet weekend and got cleared when volatility returned. XRP's participation in the sell-off added to the total and reminds us that liquidation levels in popular pairs can stack around round numbers. When those levels go, the move speeds up. A simple plan for traders who still want exposure to cryptocurrency but need to manage risk. Define your invalidation before entry. If price closes below your last defended level and cannot reclaim it quickly, step aside and let the market rebuild. Scale entries rather than going all in at once. On days dominated by liquidation levels, staged orders help avoid catching the worst candle. Separate long-term holdings from short-term trades so one bad session does not derail your bigger strategy. What would signal the worst is over? In cryptocurrency flushes, you want to see liquidation levels below price get cleared and then hold on retests. You want to see spot depth refill near intraday support. You want funding and open interest reset toward neutral rather than staying stretched. If those signals line up, bounces tend to stick. If not, expect more chop. Catalysts to watch next. Liquidity improves quickly when ETF headlines turn constructive and when market makers tighten spreads after a shakeout. If the broader macro picture stabilizes and risk appetite returns, today's cleared liquidation levels can become a springboard rather than a trap. If headlines stay negative, treat every bounce into recently cleared levels as a test until the close proves otherwise. Bottom line. According to CryptoPodo, about $600 million in positions were wiped as Ethereum and XRP led a cryptocurrency sell-off, with liquidation levels doing most of the damage once price started sliding. Use the heat maps, respect your invalidation, and let participation confirm any reversal before you size up. You have been watching CryPTOZARD News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other cryptocurrency news you would like to hear in the future. Remitix just turned a lot of heads in a hurry. According to Cryptopolitan, the presale has attracted nearly 40,000 holders and raised over $26.3 million as the project trended across X, putting a newer name front and center while bigger caps dominated headlines. The story here is not only the size of the presale. It is the pitch, a Payfy Rails project that wants to make moving money as simple as scanning a QR code and settling in fiat on the back end. So what is Remitix actually offering? According to Cryptopolitan, the Payfy system plugs into more than 100 cryptocurrencies and converts them to fiat instantly, with a merchant pay API designed so shops can accept crypto at checkout while receiving local currency without hidden foreign exchange fees. That kind of flow crypto in, fiat out aims squarely at the pain points in cross-border payments and everyday retail where card fees, FX spreads, and settlement delays chew up margins. The presale metrics help explain the buzz. The same report says over 668 million tokens have been sold at 11.3 cents, alongside a referral program that pays 15% in USDT with a daily claim. Numbers like those are the sort of growth levers that drive social traction early, and they are why you saw the project trend on X while presale dashboards ticked higher. Remitix also leans on credibility signals, assertic verification, a first centralized exchange listing confirmed at Bitmart, and an bank listing up next to broaden access once the token is live. If you are trying to separate signal from hype, focus on the parts that will be measurable after launch. For a Payfy thesis, that means tracking active merchants using the Pay API, real throughput on conversions from crypto to fiat, and repeat transactions rather than one-off promos. It also means watching how quickly on-ramps and off-ramps expand by region, since compliance and banking partners determine whether those fiat settlements feel instant in the real world or get stuck behind paperwork. There is also the remittance angle. Cross-border transfers are huge, and fees take a bite every step of the way. A system that lets senders pay with widely held crypto and lets receivers get fiat reliably can compete in corridors where traditional money transmitters are expensive or slow. The test is execution. Do fees stay low when volume rises? Do payouts land in minutes instead of days? And do users trust the process enough to come back without a promo? Let's talk risks clearly. Promotional presale articles are not independent research. They are designed to drive attention. Treat the claims as a starting point. Before committing capital, read tokenomics and vesting schedules, check smart contract audit details, look for treasury transparency, and understand the path to liquidity around a listing day. If unlocks are front-loaded or market making is thin, price can move a lot faster than the product roadmap. If you want a simple post-launch checklist, use this. 1. Does merchant adoption grow week over week, and are those merchants real businesses you can verify? 2. Do on-chain and off-chain volumes line up with the narrative stable usage without heavy incentives is a green flag. 3. Does exchange liquidity deepen and do spreads tighten as new venues list the token? 4. Does the team hit roadmap dates for additional rails or features without slipping from month to month? Those are the fingerprints of a product finding product market fit rather than surfing early hype. Here is the bottom line. According to Cryptopolitan, Remitix has momentum with nearly 40,000 presale holders, more than $26 million raised, and a pay-fee pitch aimed at turning crypto into fiat for everyday commerce and remittances. If the team ships what they promise and the merchant side scales, the thesis has room to run. If the numbers stall after listings and usage depends on giveaways, expect the story to cool as fast as it heated up. You have been watching CRYPTOZARD News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you would like to hear in the future. In 2010, a programmer swapped 10,000 Bitcoin for 2 pizzas. At today's prices, that's a jaw-dropping sum, but back then, it was proof that this weird internet money could actually buy something. That moment, now Bitcoin Pizza Day, kicked off a journey from curiosity to a fixture of global finance, with euphoric runs, brutal crashes, and a lot of hard lessons in between. Rewind to the aftermath of the 2008 financial crisis. Trust in banks was shattered. Into that moment stepped an unknown author using the name Satoshi Nakamoto with a 9-page Bitcoin, a peer-to-peer electronic cash system. According to the Bitcoin white paper, the idea was simple and radical. Cash that moves directly between people without banks, governance, or middlemen, secured by math, not managers. Satoshi didn't pitch a concept, they shipped working code. On January 3, 2009, the Genesis block was mined, with a message referencing a newspaper headline about bank bailouts, a time capsule of the era's frustration. Early activity lived on forums like BitcoinTalk, where cryptography nerds tested the software and sent tiny amounts back and forth. Public blockchain records and early marketplace posts show one of the first dollar exchanges valued a single Bitcoin at less than a penny. No marketing, no CEO, no roadmap, just open source software and a community experimenting in the open. Then the mystery deepened. By 2011, Satoshi was gone. No conference talks, no victory lap, no cash out. What they left behind was a functioning network and an unsolved riddle, the identity of the creator of $1 trillion idea. The real-world stress testing started in 2010 and 2011. The pizza tray demonstrated utility. The next few years exposed growing pains. Gox, a site that pivoted from trading game cards to handling most Bitcoin trading by 2013, became crypto's central venue until it didn't. In early 2014, withdrawals froze. Weeks later, bankruptcy. Major outlets like Reuters reported roughly 744,000 customer Bitcoin missing. Prices collapsed nearly 90% from the highs, and the world learned a painful truth. In a system built to remove trusted intermediaries, the weakest link was still human custody and exchange security. That failure forced upgrades across the ecosystem, better cold storage, proof of reserves conversations, and a push for clearer operational standards. Meanwhile, Bitcoin kept upgrading on-chain. Halvings pre-programmed events that cut the new coin issuance rate roughly every 4 years arrived exactly on schedule. Scarcity wasn't a marketing slogan, it was embedded in the protocol's math, and it changed how investors modeled the asset. Institutional curiosity turned to engagement. The 2017 cycle dragged Bitcoin into the mainstream as prices approached $20,000 and CME and CBO-listed futures, giving traditional funds a regulated way to trade. In 2021, El Salvador made Bitcoin legal tender, an unprecedented national experiment. Upgrades like Taproot improved privacy and efficiency, and the Lightning Network made small, fast payments feasible, proof that development didn't stop at number go up. Then came the floodgates moment. In early 2024, the SEC approved spot Bitcoin ETFs from a slate of major issuers. Instead of figuring out self-custody, investors could buy exposure through a familiar wrapper in traditional brokerage accounts. Trading began, liquidity deepened, and new highs followed. According to public filings and industry trackers, those ETFs reshaped access and brought a steadier, programmatic bid that didn't rely on retail hype cycles alone. Across these chapters, the pattern repeats: innovation, stress, adaptation. Halving cycles create predictable scarcity. Market infrastructure from custody to ETFs broadens participation. And yet, volatility never fully disappears. History shows multiple drawdowns greater than 60%, each followed by periods of rebuilding and renewed adoption. That's why seasoned observers focus on fundamentals as much as price, hash rate and security, developer progress, on-chain settlement, and the expanding menu of regulated access. For context, much of this story is verifiable through the Bitcoin white paper, public blockchain data, and reporting from major outlets such as CoinDesk, Reuters, and others. So what are the takeaways from pizza to Wall Street? First, decentralization gave Bitcoin durability: no CEO to fire, no headquarters to raid, no money printer to change the rules. Second, trust had to migrate from people to processes, audited custody, transparent exchange practices, and clear regulation. Third, adoption doesn't move in a straight line. It compounds as technology improves and access widens. From an anonymous PDF to an asset on brokerage menus and national balance sheets, Bitcoin's arc is still being written. The open question is how the next blend of policy, technology, and market cycles will shape its role in the global system. But if history is a guide, the network will keep doing what it's done since Block 1, producing blocks every approximately 10 minutes while the world around it catches up. You have been watching CRYPTOZARD News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you would like to hear in the future. A new politically charged token just landed on a mainstream brokerage. According to Blockchain Magazine, World Liberty Financial's WLFI is now listed on Robinhood, drawing fresh retail attention because it blends a crypto launch with high-profile backers and a promise of liberty-themed payments tools. So what is WLFI meant to do beyond the headline? The Blockchain Magazine piece says the project pairs its governance token with a stablecoin and plans retail payment rails, including checkout integrations and a debit card experience, framing WLFI as the Votan-governed layer in a broader payment stack. That positioning matters because a Robinhood listing doesn't just add liquidity. It puts the token in front of millions of funded accounts that prefer familiar brokerage apps over crypto-native exchanges. There's deeper context behind the rollout. According to Reuters, World Liberty Financial has been working toward greater transparency around its USD-pegged stablecoin, promising an audit and a simplified app while signaling that the WLFI governance token would become tradable as policy rails took shape. That disclosure push, combined with exchange listings, is part of the pitch to move WLFI from a presale and governance story into day-to-day usage. Price action has been volatile, which is typical for a fresh listing with heavy media attention. Major outlets have reported eye-popping early turnover and sharp intraday swings as the token moved from presale to open trading before settling into lower ranges as liquidity found a level. That mix: fast volume, quick retraces, then consolidation is what you'd expect when a new asset leaps from a niche community into wider markets. What should you watch now that WLFI sits on Robinhood as well as big crypto venues? First, follow actual product milestones, stablecoin audits posted on time, merchant integrations going live, and any debit card or point-of-sale pilots beyond promos. Second, track participation quality. Not just headlines, does unique wallet activity and real-world payment throughput build week over week. Third, keep an eye on order book depth and spreads on both Robinhood and major exchanges. Tight spreads and growing depth usually mean market makers are comfortable stepping in, which helps dampen whipsaws. And remember that some coverage has noted Robinhood's listing didn't instantly produce sustained upside flows, can arrive in waves as distribution switches on across platforms. Risks are straightforward. Governance tokens live and die by disclosures and tokenomics. If vesting and unlock schedules outpace organic demand, price can drift, even if headlines stay hot. If audits or payments integration slip, confidence fades. And because WLFI's narrative is intertwined with politics, regulatory tone shifts can amplify volatility in both directions. None of that is unique to WLFI, but the mix of retail access, a stablecoin component, and political branding makes the feedback loop louder. Bottom line, according to Blockchain Magazine, WLFI's debut on Robinhood moves the token from a community launch into the retail mainstream. But staying power will depend on audited stablecoin rails, real merchant usage, and consistent liquidity across venues. If those pieces show up on schedule, the listing becomes a bridge to utility rather than just a headline pop. You have been watching CryPTOZARD News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you would like to hear in the future. Exodus movement just caught a bid, and the timing is interesting. On the day Google marks its 27th birthday, one of crypto's most recognizable wallet brands is back on traders' screens. According to Nasdaq, shares of Exodus movement, ticker EXID, jumped about 12% in the last session to close near $32, capping roughly a 6% climb over the past 4 weeks. The move came on heavier than normal volume, and the write-up credits a few specific growth angles: rising stablecoin adoption, a MetaMask integration that broadens reach, and new retail-friendly features like XOSwap and XOPay aimed at making crypto access simpler. Nasdaq's piece also notes consensus expectations for a small quarterly loss as the company invests in product, with revenue projected to grow roughly 25% year-over-year, so the bull case here is less about instant profitability and more about user growth translating into top-line momentum. What does that mean if you're watching the tape rather than the narrative? With a story like Exodus, price usually follows to things, product adoption you can measure, and broader crypto liquidity. If XOSwap and XOPay drive more in-app activity and stablecoin volumes keep expanding, it shows up as higher transactions per user and steadier take rates. On days when Bitcoin or majors are firm, wallet names tend to catch flows. When the market chops or sells off, they trade like high-beta software fast both ways. The practical checklist is simple. Look for sustained volume above average, higher lows holding after green sessions, and updates that confirm distribution partnerships and usage rather than just headlines. If the stock gives back gains immediately on light news, the move is likely positioning, not a trend. It also helps to separate story risk from execution risk. Story risk is whether self-custody wallets remain a priority if spot crypto ETFs keep soaking up mainstream demand. Execution risk is whether Exodus can convert feature launches into stickier daily active users and growing payment flows. The first is a market structure question. The second is a roadmap and product market fit question. Either way, near-term results will probably hinge on evidence that new integrations like MetaMask are widening the funnel, while monetization expands beyond one-time swaps into recurring, payment-style activity. And yes, about that timing, it's Google's 27th birthday today, a reminder of how distribution and usability can turn a niche technology into everyday infrastructure. Google marked the day with an official birthday doodle that brought back its original 1998 logo. A little nostalgia hit that also underlines a serious point for any consumer tech company. The fastest path to durable growth is making complex things feel simple and familiar. That's the bar wallet apps are trying to clear as crypto pushes further into the mainstream. Bottom line, according to Nasdaq, Exodus movement stock pop reflects renewed interest around stablecoin rails, integrations, and retail-friendly features, with investors betting product traction can outrun near-term losses. If usage climbs and volumes stay elevated, the story can compound. If not, Expect the stock to trade with broader crypto risk until the next proof point arrives. You've been watching CRYPTOZARD News. Please subscribe and like, and leave a comment if you enjoyed this video, and let me know what other crypto-related news you'd like to hear in the future.